Hello everyone and welcome to episode 3 of KATA Connect. Today I am joined by the one and only Drew Cooper from Global E-commerce Experts. Drew, how are you?
Very well, Piero, thank you. Pleasure to be here. Great to see you again. I think it's been a little while actually since we actually seen each other in person.
Absolutely.
Being just down the road. But thanks for having me. Look forward to it.
Yeah, perfect. The main reason why I wanted Global E-commerce Experts on this episode is it's something that I'm currently pushing quite a lot towards KATA Global Logistics clients. It's understanding why long-term warehousing solutions are so important. It's a viable business for you guys, but also it's very important to the business that we deal with to understand what are the perks of having long-term warehousing. The main reason I've been doing quite a lot of videos online on our Instagram page and our LinkedIn pages, talking about why constant shipping is not only not very environmentally sustainable, but currently I'm going to talk about a lot about the ocean freight and rail freight volatility and the price volatility. And I have a perfect example of the price of the last 6 months. And I'm hoping for your input, understanding the cost and the benefits of long-term warehousing on certain particular locations. I know Global E-commerce Experts are based in the UK and the Netherlands. I also want to speak about why those locations are so important and so beneficial to our clients. So let me start straight away with some pricing, actually, understanding the difference between October 2023 and currently March 2024. Okay, we're talking about a 6-month period. And I want to speak about percentages of how ocean freight has risen and now is slightly coming down. We're going to talk about the Red Sea surcharges as well that's affecting our sellers constantly. In October 2023, the price of a 20-foot container from China to Europe, we're looking around the 1,700 USD. Okay, now at the peak of it, the peak of our 20-foot container, which was around January 2024, just before Chinese New Year, we're looking into Europe, we're looking around the £3,000 USD mark. Okay, so nearly 100% rise in cost for a 20-foot. 40-foot, even worse. We're looking at 125% rise. January tends to be, especially for this year, was a particular time because it wasn't just Chinese New Year affecting prices for that period, because there's businesses that are trying to fulfill their goods last minute, but also because the Red Sea surcharges got added. And I'm going to talk about that on our vessel line experience. But the main point that I'm trying to make is having such a rise and not being very planned with your inventory really affects your bottom line. And what I mean with the bottom line is the profitability that you have on your products. I think from our experience, Drew, I know that a lot of our sellers are being Amazon based as well. You know, the profit margin is the biggest deal. You know, that margin has to be as large as possible, because yes, you get the volume, but at the same time, the margin that Amazon, due to Amazon costs, you've got to try and make that as well as possible. So having a warehouse like Global E-commerce Experts, how does that bottom line get affected really? It's a question for you.
Yeah, it's a good question. I just want to touch on the volatility element of it, because as we know, over the years, shipping prices, as you've given some stats on, have been up and down, and it varies depending on, time of year, whatever eventualities are happening in the world, which sometimes is quite easy to predict. We know that Christmas is happening. We know Chinese New Year is happening. We don't know that there's going to be the start of what was going to be a war in the Red Sea, and subsequently we can't plan for that. And of course, neither can the shipping company, essentially. So, what we're seeing, to touch on that, is double bubble really. So we've got, at this instance, the issues in the Red Sea, Chinese New Year. We're seeing shipping prices being 25-30% of what they were through COVID. Some of that increase in price because of surcharges. We've also got, the transit times increasing because, of course, it's volatile in that time. So I think it's even more important, if there's any opportunity to foresee or to make any judgment calls or to continue doing your research into what's happening in the world outside of just the shipping lane from China to the UK, it's really important to build that into how much stock you think you're going to need. Yeah. And I totally understand and have these conversations regularly with our clients about how on earth do we really do that? How do we look into the future essentially? But we're not necessarily talking about that. We're saying a bigger picture about, as I mentioned, other stuff that's going on in the world and the possible impact of that on getting your goods into Europe or the UK or US or wherever you're going, and build that into how much stock you think you're going to need. Are the shipping prices at a level where they're comfortable? Pretty much all through 2023 and up until relatively recent, they're pretty stable. Or we had months of them being up and down slightly, but nothing too significant. At that point, was at the right time to think, okay, typically I wouldn't be purchasing more stock now because my peak isn't until September, October, and now in March. But is it the right thing to do to purchase more stock, fill a 40-foot container as opposed to a 20-foot or whatever the case may be, and put that stock in a warehouse? Yeah, find a warehouse that's suitable, which I can't exaggerate how important that is to make sure that you don't just go for the cheapest, you don't just go for the most experience in your field, you actually do some investment into that. If you rent a 3PL, store at a reasonable rate that doesn't really affect your profit margin too much, and then drip feed that stock into Amazon. If that's your port of call.
No, Drew, I completely agree. Simply because I'm looking at, I look at quite a lot on truckloads and LCL shipments, right? And the way volume, the amount of times I say to our clients that volume matters in terms of shipment. I have a perfect example because with KATA Global Logistics, having our own customs trading department, we look at a lot of EU, UK, EU, and I'm sure you do as well with your stock triangle from the UK to the Netherlands and back. So on a current, let's say on a rate card basis, having one pallet shipped via road between those two countries, we're looking around a €400 cost, 400 and 450 euros to 500 euros, depending on who the provider and the freight forwarder is, okay? Now, from 450 euros for one pallet, you're looking at 10 pallets can be almost a full truckload. You're looking at around 1.4K. So less than triple the price for 10 times the stock. It just shows you how that unit cost decreases dramatically for your product, which my main point about profitability, about your product cost analysis, the volume changes your profitability on the product that you sell. And that's really important. Now, if we look at a full truckload, you can fit 30 pallets in, up to 30, even a little bit more depending on the size of your boxes and your palletized and how you're palletized. But you're looking around 2.5K for a full truck, okay? So if you've gone from 500 euros to pounds for one pallet, and you're looking at 5 times the price for 30. So I don't have to do the maths. I think anyone that's watching this will understand the profitability that you get and the cost per unit that you have is a massive margin maker, especially dealing on an online marketplace base.
Yeah, absolutely. And of course, we've got to take into consideration whether brand, the client can afford, if they've got the money to be able to make those decisions. Absolutely the right thing to do, of course, because as you've quite nicely put it there, the amount you're going to save by sending a full truckload or a full container load as opposed to an LCL shipment is going to be significant. You're going to make a huge saving, and at the end of the day, when your goods get here, all of that money is your profit. So, and it's done like it take a rocket scientist to work that out, but it's whether you've got to balance up whether those goods are going to sell in time, so therefore you're going to be able to retain that profit, because that's the key thing. You need to balance up whether sending a bigger shipment versus the output of sales on channels. Are you going to be able to nicely balance and do you have the sales velocity in your domestic market that you can replicate in Europe? If you do, fantastic. They're likely to work. If you don't, and you're sending more stock than you sell in a year, then of course it might not be entirely appropriate, to do that.
Yeah, absolutely. I think on a bigger picture, then I want to relate this to the warehousing side of things. Absolutely, you're right. Yeah, I can send 7 truckloads worth of goods, but I'm only selling half of one in a year basis. Of course, that doesn't quite make sense. However, I think that warehousing options also opens up different gates. Now, we've spoken about drip feeding into Amazon for our Amazon sellers, but a warehousing like yourself, there is a 3PL solution at the same time. I think it opens up gates for different possibilities, different revenue streams, different channel optimization, for example. How do you think that has affected your type of client? Let's say I'm sending 5 pallets across. One of them is going to Amazon, but the others I am dealing on another marketplace basis. How many of those clients are affected and you help through warehousing?
So every client in our warehouse, we recommend that they open up an omni-channel approach. Now, the direct answer to your questions, if you've got 5 pallets, you're sending over to the Netherlands. Bring those 5 pallets into the Netherlands facility, cross-dock straight away 2 pallets into Amazon. You've then got 3 pallets sat there. Nobody, not a warehouse, not a client, nobody wants stock sat anywhere. It's not profitable for the client. It's used space that isn't making much margin for a warehouse, because long-term storage is, unless you're set up for that, it's not what, a 3PL wants. So you want that stock to be continuously moving. So by having other options, so by opening up, selling on Amazon, open up eBay, open up BOL.com, go to Fnac France and open up all those other avenues, depending on your product category, because you're not taking anything away from Amazon. You're just taking a different market and essentially your stock's moving. So whether it's moving for, 1% margin, it's better than being sat in there for no percent margin. So I think, everybody gets recommended that. And without a shadow of a doubt, send as much stock as you can into Amazon. Yeah, that is always a recommendation. Use all your stock limit, actually get it in there, keep topping it up. Absolutely the right thing to do. But alongside that, open up some other avenues. I think the other thing to note here is with, FBA replenishment, if you're sending over an LCL shipment of a couple of pallets and you can get all of that stock into Amazon, fantastic. Yeah, it's going to cost you, X amount per cubic meter to ship it, get it into Amazon. But you've then got, whatever, a 5-6 week transit, depending on where it's coming from, and probably more at the moment with the Red Sea, to get it there when you're close to stocking out. Now, unless you're the data you've got is absolutely dialed in to make sure that you're notified about it being really low and you can manage that really well, the likelihood is it's probably going to stock out. And as we all know, we definitely don't want to be doing that in Amazon. So having that sort of buffer, as it were, having some stock, still moving. Maybe you won't sell it, you won't have some sales velocity on some other marketplaces, but it doesn't really matter. As long as it's selling, you can build it. You've got some sales going out, bringing in some revenue, and then you can easily replenish to Amazon FBAs. Now, just also to note as well, if you're in Europe, slightly different than the UK, because of course we're a small island and cross-border fulfillment is pretty much...
too complicated, way too complicated.
But when you're in Europe, similar to what you can in the US, you can move your goods throughout states with ease. Exactly the same in the US. So by having a 3PL in Europe, it not only opens up the doors to send it into an FBA in Germany, you've got options all over Europe. You can do D2C on your Shopify site, for example, to all of Europe from one 3PL. And as you mentioned a minute ago, Piero, it's unachievable on Amazon. So, there's multiple reasons: cross-border, omni-channel, and not have your stock stay anywhere, essentially.
Absolutely. Really, really good points. Great advice as well. And one final point that I wanted to make is how essential geography is and taxation is in Europe. And G complements this perfectly. And I want to really stress how important warehousing in the UK and particularly the Netherlands is so important. Okay, so the UK, obviously, since Brexit, being its own island, as you said, cross-border not being a strong option. If the UK is a massive market for you, having a 3PL solution in the UK is very important. That has to be used for the UK only, though. It's a market of its own. I started telling clients, look at the world map, but just move the UK completely away from Europe. It's not that close. There's a massive border in between. It's not just the channel. It's a massive massive trade border now. So it's almost a continent of its own. That's what I say for trade purposes. And then the Netherlands becomes a fantastic gateway to Europe. One, the amount of times I've spoken about Rotterdam Port being one of the best ones in the world, because it is one of the best ones in the world. And also with KATA doing its own clearances and having our basin being the Netherlands as well, we know how quick it is to actually clear the goods in the Netherlands compared to other countries in Europe. Now, if I go and compare it to a different trade zone in the EU, we're looking at Germany. Germany still works on a personalized check basis. So whilst Netherlands has a automated system that actually basically gives you a possibility to check the clearance and actually clear the goods, in Germany, there's still an investigator that checks every single clearance. So in terms of timing of the goods getting cleared, you're looking at massive differences from, on an hourly basis, 2 days taken for the goods to be cleared. Poland becomes a good option for warehousing because of the cost effectiveness. However, for any non-EU trade, importing to Poland becomes a little bit of a nightmare because of VAT issues, needing a Polish VAT account, a Polish bank account to be able to reclaim Polish VAT as well, not having necessarily the easiest deferral scheme as well. As much as, yes, it's a cheap option, but importing into Poland is not necessarily the best. So it only really becomes an option for European manufacturers, I'd say. So for anyone importing goods from China, Netherlands is still a fantastic option. And in terms of pricing, to be honest, looking at Germany, if you compare it to France, Netherlands still has a very good pricing as well, and it ease to import goods. Businesses that have a Netherlands VAT number can use and get an Article 23 license that helps them defer VAT on a regular basis as well. So in terms of ease of importation, in terms of possibility to help your cash flow as well, and overall service as well, that Netherlands options becomes really one of the best ones for the EU.
Absolutely, for sure. And you summed it up really nicely. I think, Netherlands, outside of all the customs clearance, expedition through there, and the that deferment, which of course is good if you're sending in larger shipments and you want to, keep cash flow nice and tidy. But also, I think it's really important to note that, in Europe, there are multiple languages where sometimes the communication between different countries, and in this example, I'm going to use Germany, the Dutch are predominantly English speaking. So therefore, communication tends to be a bit more fluid. Now, of course, that's up for debate and it's an assumption, but in Germany, it's far trickier to pick up the phone, have those conversations should there be a problem, as opposed to the Netherlands. And again, it's really important to know when you're in Europe, you can distribute those goods freely throughout Europe. So pick the easiest country, pick where you can have less friction, you can get through with ease, and you've got, it's quite widely known now that Holland or Netherlands is widely used for importation into Europe, and it's a good reason. The UK as well, I think, just going back to that, Piero, remember the UK is very small. So when we're talking about stock limitations, if we take US sellers as an example, they likely have far greater, not only because they're more established, far greater stock limits than Amazon. So they can store more stock, they have longer in order to worry about replenishing that stock. When it comes to the UK, we're tiny. But we're a big market. So stock limitations in Amazon, not so much at the moment. This in 2024, certainly through 2022-23, really restricted about how much stock you can keep in there. So even more reason to identify that, work on identifying a 3PL that works for you, and use that. And I think just one final note, I'm just coming up with these. With a 3PL, if you're an overseas seller trading in the UK or Europe, you're going to have returns, from Amazon. You're going to have stockpile of return, unfortunately. Have them, sat in Amazon, and they've got to go back somewhere at some point. Now, they won't send them to your domestic market if you're, say, for instance, in the US or in China. So you need to return them to a UK or European facility in order for them, the 3PL, then to ship back to you if that's what you wanted to do, or destroy them or whatever. So it's worth noting as well that on the preparation to expand, or if you're already trading and you're looking for 3PL, make sure that you're going to get all those boxes that you need are going to be ticked. Returns, potential to do an omni-channel D2C. You're going to be able to rework your goods if they require it, and they're going to be able to FBA track appropriately.
Yeah, I think that's a fantastic point that I forgot to mention, where it's something that I recommend a lot of fashion and textiles type of brands, because they have the highest return percentages of all types of industries in terms of categories. So that 3PL is a must-have, especially for non-localized sellers. I mean, these brands are expanding in such a way that 3PL becomes an essential part of what they need. And having someone, a 3PL, that can actually deal with the returns management, actually be able to repack and actually resell the product as well, it makes your product so much more cost effective. So it's a great point. That's it. Thank you so much for your time, Drew. Thank you everyone for watching episode 3. For KATA Global Logistics, if you want to get in touch, you can go through inquiries at katagloballogistics.com. Drew, how can anyone get in touch with global e-commerce experts?
Feel free to find me on LinkedIn. You can search under my multiple aliases as Piero, Andrew, Andy, Drew, Cooper, any of them, or you can find some global e-commerce experts. Topic Google, pop up, and feel free to reach out.
Basically, thank you so much. Thank you for watching.
Thanks, Piero. Cheers.